You spend 3 months learning candlestick patterns. You memorize support and resistance levels. You study moving averages, RSI, MACD, Fibonacci retracements. You watch hours of analysis videos. You download books written by former floor traders. You join Discord servers where people share setups. You paper trade until your imaginary account doubles. You feel ready. Then you open a position with real money, watch it move against you by 2%, and panic sell at the worst possible moment. The chart was perfect, the setup was textbook, every indicator aligned, but you still lost. This happens to almost everyone. And the strange thing is, the response is always the same. They go back to studying. More indicators, more patterns, more complexity, as if the problem was incomplete knowledge, as if they just needed one more tool in the analytical toolkit. They search for the secret indicator nobody talks about. They pay for courses that promise to reveal what the professionals know. They convince themselves that somewhere out there is a pattern, a formula, a system that will finally make it click. But here's what nobody says out loud. The person who wins isn't the one who knows more patterns. It's the one who doesn't panic when the pattern fails. It's the one who can watch their account drop 3% and not feel anything. It's the one who can lose 5 trades in a row and still take the 6th trade exactly according to plan. You already know this, somewhere deep. You've watched traders with less knowledge do better. You've seen people make money with simple strategies while experts blow up their accounts. You've read stories about traders who use nothing but basic support and resistance and make consistent returns year after year. The explanation you've been given is that they're lucky or fearless or naturally talented, that they have some innate gift for reading markets. But that's not what's happening. What's happening is they've solved a different problem entirely, and it's not a technical problem. The real issue isn't what you know, it's who you become under pressure. It's what happens to your decision-making when money is on the line. It's how your nervous system responds to uncertainty. And this is something that no amount of chart study can fix. Most people approach markets like they're solving a puzzle. They believe that if they can just decode the patterns, predict the movements, understand the indicators deeply enough, they'll win. This makes sense. Markets do have patterns. Technical analysis does work sometimes. Price does respect certain levels. Trends do exist. None of that is wrong. But this entire frame is wrong because it assumes your limitation is knowledge. It assumes you're a rational machine that just needs better data, better tools, better information. You're not a machine. You're a nervous system that evolved to survive, not to optimize. And that nervous system has responses that happen faster than thought. When you see red candles, when you watch your capital shrink, when you feel that tightness in your chest, your brain isn't consulting your knowledge of Bollinger Bands. It's not running through your checklist. It's not remembering that time you backtested this exact setup. It's asking a much older question. Am I safe? This is the question that determined whether your ancestors survived or died. Am I safe from the predator? Am I safe in this social group? Am I going to have enough resources to make it through winter? Your brain is extraordinarily good at answering this question. It's been refining the answer for millions of years. And the answer comes through feeling, not thinking. Fear, anxiety, relief, excitement. These feelings are designed to make you act immediately, without deliberation, because deliberation takes time, and sometimes you don't have time. In most of modern life, this system is outdated. You're not running from predators. The discomfort you feel isn't warning you about immediate physical danger. But your nervous system doesn't know that. It can't tell the difference between a genuine threat and watching your trading account drop $200. Both trigger the same ancient circuitry. Both feel like danger. Both demand immediate action. This is why someone can know everything about technical analysis and still make terrible decisions. Because in the moment of decision, knowledge isn't what's driving behavior. Fear is. Hope is. The need to be right. The need to recover losses. The need to prove something to yourself or to others. These forces don't care what you know. They override knowing. And they operate through patterns that have nothing to do with charts.
The mechanism is simple but devastating. Every time you make a decision from fear or greed, you're not just making one bad trade, you're reinforcing a behavioral pattern. You're teaching your nervous system that this is how you respond under pressure. Your brain learns when it's uncertain, we panic. When we're winning, we get overconfident. When we're losing, we revenge trade. When we feel the need to be right, we ignore our rules. These become automatic, not choices, reflexes. And here's the part that ruins people. You can't think your way out of a reflex. You can understand intellectually that revenge trading is bad. You can write it down. You can promise yourself you'll never do it again. But the next time you take 3 losses in a row and feel that burning need to get your money back, you'll do it anyway. Because the part of your brain that makes promises is not the same part that acts under stress. Consider 2 people who start learning to trade at the same time. Call them Maya and Jordan. Both are intelligent. Both are motivated. Both study the same material. Both understand technical analysis at roughly the same level. Both have similar capital to start. Both want to make this work, but their trajectories diverge completely within a year. Not slowly, dramatically. Jordan approaches trading like school. He wants to master the content. He learns every indicator, backtests strategies, joins communities, watches endless analysis. His screen has 17 different tools running at once. Multiple time frames, volume profiles, order flow indicators, market internals. He can explain Elliott wave theory in detail. He understands Wyckoff accumulation and distribution. He prides himself on his knowledge. When other traders ask questions in forums, Jordan answers them. He feels competent. He feels prepared. But when he trades, he's inconsistent. Sometimes he follows his plan. Sometimes he doesn't. Sometimes he takes perfect setups and closes them too early because he's afraid of giving back profit. Sometimes he holds losing positions way too long because he's convinced the analysis is right and the market is wrong. Sometimes he takes trades that don't meet his criteria because he's been watching the chart for 3 hours and feels like he needs to do something. Sometimes he skips perfect setups because the last trade was a loser and he's not sure anymore. He tells himself it's because the market changed, or the setup wasn't perfect, or he saw something others missed. He has explanations for everything, but really, he just feels things. Fear when positions move against him, excitement when they move in his favor, boredom when nothing is happening, frustration when he misses moves, desperation when he's down for the month. And these feelings make him act in ways that contradict everything he knows. After bad trades, Jordan studies more. He watches the replay of the price action. He identifies where he went wrong. He tells himself it won't happen again. He thinks the problem is that he's missing something, some hidden pattern, some advanced technique the professionals use. He adds more indicators. He reads books about market microstructure. He learns about options flow and dark pools. He makes his system more complex. He's trying to think his way to control, trying to find the piece of knowledge that will finally make him consistent. But his account slowly bleeds, not through ignorance, through emotion, through the gap between what he knows and what he does. And the more he loses, the more desperate he becomes to find the answer. The more desperate he becomes, the more he studies. It's a loop, and he can't see that he's solving the wrong problem. Maya learns the basics of technical analysis in her first 2 months and stops there. She knows how to identify trends. She knows how to spot support and resistance. She understands basic price action. She can read volume. That's enough. She knows it's enough because she's watched traders succeed with less. She's read interviews with professional traders who say they use simple methods. She trusts that the complexity isn't in the analysis, it's somewhere else. So she spends the rest of her time on something different. Every morning, before she looks at charts, before she checks what happened in overnight markets, before she does anything related to trading, she sits with a notebook. She writes down her current emotional state, not in a vague way, specifically. Am I anxious? About what? Am I confident? Why? Am I tired, bored, excited, angry about something unrelated to trading? She doesn't judge any of it. She just names it. She makes the invisible visible. Then she writes down her rules for the day, the same rules she wrote yesterday. She doesn't skip this step even though she's written them the same 100 times. The repetition is the point. She's not trying to remember them, she's trying to embody them. She writes, I will only take setups that meet all my criteria. I will risk 1% per trade, never more. I will not trade if I feel emotional. I will close my platform after 3 losses in 1 day. I will not revenge trade. I will not overtrade. Then she writes down what would make her break those rules. This is the part most people skip. They write down what they should do, but they don't name the conditions that would make them do otherwise. Maya does. She writes, I will want to break my rules if I'm bored, if I feel like I'm missing out. If I've lost money and feel desperate to recover, if I'm trying to prove something, if I had a fight with someone, if I'm comparing myself to other traders. Before every trade, she pauses for 10 seconds, not because 10 seconds is magic, because those 10 seconds interrupt the automatic response. She asks herself, am I doing this because the setup is good or because I feel something? Most of the time, it's both, but sometimes, when she's honest, she realizes the setup is marginal and she's only considering it because she's bored or because she wants to be in the action. And in those moments, she closes the chart. After every trade, win or lose, she writes what she felt and what she did. If she followed her process, she writes why it was easy or hard to follow. If she broke her process, she writes what feeling drove her to break it. She's not trying to eliminate emotion. She knows that's impossible. She's trying to see it clearly. She's trying to understand the patterns of her own behavior. Over time, Maya notices patterns in herself that have nothing to do with markets. She sees that she trades poorly after arguments with her partner. She sees that she overtrades when she's bored or procrastinating on other work. She sees that after 3 losses, something shifts in her and she starts looking for revenge. She sees that when she's winning, she gets sloppy and starts taking marginal setups. She sees that late in the afternoon, her decision-making deteriorates. She sees that on Mondays, she's more cautious, and on Fridays, she's more aggressive. She doesn't judge these patterns, she just sees them, and because she sees them, she can work with them. She builds rules around her emotions, not around the market. If she's had an argument, she doesn't trade that day. If she's bored, she goes for a walk instead of forcing trades. If she feels desperate to recover money, she closes her platform and doesn't open it again until the next day. If it's late afternoon, she stops trading regardless of opportunities. If she's on a winning streak, she reduces her position size instead of increasing it. These rules seem arbitrary from the outside. They're not based on technical analysis. They're not optimizing for maximum opportunity, but they're optimizing for something more important, behavioral consistency. They're protecting her from herself. A year later, Jordan has more theoretical knowledge than Maya. He can explain concepts she's never studied. He can identify patterns she doesn't have names for. He's objectively more knowledgeable about technical analysis. But Maya has something else. She has behavioral consistency. And in markets, behavioral consistency beats technical mastery every single time. Not because technical mastery doesn't matter. It does. You need some baseline level of knowledge to identify good opportunities. But beyond that baseline, which is lower than most people think, additional knowledge doesn't improve results. What improves results is being able to execute the same process regardless of how you feel. And that's not a knowledge problem. That's a behavioral problem. Here's why this matters so much. Markets reward people who can do the boring thing correctly 1,000 times in a row. They reward consistency over brilliance. They reward discipline over insight. This seems wrong to most people because in other domains, brilliance matters. If you're a scientist, a brilliant insight can change your field. If you're an artist, a moment of creative genius can define your career. But trading isn't like that. Trading is more like brushing your teeth. The benefit comes from repetition of a simple process, not from doing it in an innovative way. The people who fail don't fail because they're not smart enough or because they don't know enough. They fail because they can't do the boring thing correctly when it matters. They fail because they deviate, because they get creative at the wrong times, because they let their emotions override their process. And every deviation, every moment of inconsistency is expensive. What's happening here isn't mysterious, it's just how learning works at the neurological level. When you study technical analysis, when you learn about patterns and indicators, you're building knowledge in your prefrontal cortex. This is the part of your brain that handles abstract thinking, planning, analysis. It's slow, deliberate, effortful, but it's also powerful. It can understand complex systems, it can make predictions, it can learn from mistakes. But when you need to execute a trade, especially under stress, your brain shifts modes. The prefrontal cortex gets partially overridden by older systems. The amygdala, where your fear responses live, becomes more active. The striatum, which handles habits and automatic behaviors, takes over more of the decision-making. This is an evolutionary feature, not a bug. In dangerous situations, you don't have time to think. You need to act, so your brain shifts to faster, more automatic systems. This is why you can know exactly what to do and still not do it. Your knowledge is stored in one system. Your behavior under pressure runs through another, and these systems don't always communicate well. The technical knowledge you've spent months building becomes less accessible precisely when you need it most. Meanwhile, your emotional habits, the patterns you've reinforced through repetition, become more dominant. The only way to bridge this gap is through repetition under real conditions. You have to practice the behavior you want while you're actually feeling the emotions. You can't simulate it. You can study all you want in calm conditions, but that's not where you need the skill. You need the skill when your heart is racing, when you're afraid, when you're excited, when you're desperate. And the only way to build skill under those conditions is to practice under those conditions. This is what people miss when they obsess over technical analysis. They're practicing the wrong thing. They're practicing analysis in calm conditions, with no money on the line, with no emotional stake in the outcome. But the skill they actually need is emotional regulation under uncertainty. And that's not a technical skill. It's a behavioral one. Think about what happens in a typical losing trade. You enter a position based on your analysis. The setup looks good. You have a clear stop loss. You have a clear target. You know your risk. Everything is planned. Then price moves against you. Not dramatically, just normal volatility, but you feel it. There's a physical sensation, tightness in your chest, a slight nausea, an urge to do something. This is the critical moment. This is where everything is decided. Not when you enter the trade, not when you exit, but in this moment, when you feel discomfort and have to choose what to do with it. If you're behaviorally consistent, you do nothing. You trust your plan. You let the stop loss do its job if it gets there. You don't interfere. But if you're not behaviorally consistent, you start negotiating with yourself. The negotiation is subtle. It doesn't feel like you're breaking your rules. It feels like you're being smart. You think, maybe I should move my stop loss a little wider, just in case this is a false breakdown. Or maybe I should take some profit here, even though it hasn't hit my target, because at least I won't lose. Or maybe this setup wasn't as good as I thought, and I should just exit now before it gets worse. These all sound reasonable in the moment, but they're all deviation. They're all breaking your process, and they're all driven by discomfort. The person who wins is the one who feels that same discomfort and doesn't act on it. They notice the feeling, they acknowledge it, but they don't let it change their behavior. They stick to the plan, not because they're more disciplined or have more willpower, but because they've practiced not acting on discomfort so many times that it's become automatic. They've built a different relationship with the feeling. There's a principle here that extends beyond markets, but it shows up most clearly in markets because markets punish behavioral inconsistency immediately and precisely. The principle is this: your edge isn't what you know, it's what you do when what you know stops working, because everything stops working eventually. Every strategy has drawdowns. Every pattern fails sometimes. Every indicator gives false signals. The question isn't whether you'll face uncertainty and loss. The question is who you become when you do. Most people become smaller versions of themselves. They second guess, they freeze, they abandon their process. They desperately search for a new system, a new indicator, a better answer. They blame the strategy, they blame the market, they blame themselves for not knowing enough. They're trying to think their way out of a feeling, and markets eat them alive. But a small number of people do something different. They become more themselves, more consistent, more disciplined. Not through willpower, not through trying harder, but because they've built an identity that includes uncertainty. They've practiced being calm when things go wrong. They've repeated the behavior so many times that it's not a choice anymore. It's just what they do.
This compounds in ways that are hard to see from the outside. A person who can execute their process consistently doesn't just avoid bad trades. They build trust with themselves. Every time they follow their rules, especially when it's difficult, they're proving to themselves that they can be trusted. This trust becomes a foundation. It creates a sense of control that has nothing to do with controlling the market. They can't control what price does, but they can control what they do, and that control is deeply stabilizing. Meanwhile, the person chasing technical mastery stays on an emotional roller coaster. They break their own promises. They tell themselves they won't revenge trade, and then they do. They tell themselves they'll stick to their stop losses, and then they don't. They tell themselves they'll be disciplined tomorrow, and then tomorrow comes and nothing changes. Each broken promise erodes trust, not trust in markets, trust in themselves. And without self-trust, there's no foundation. There's just chaos. The emotional experience of these two people is completely different. The behaviorally consistent person has bad days. They have losing trades. They have drawdowns, but they don't spiral. They don't question everything. They don't feel like they're failing.
They see losses as part of the process, as information, as the cost of doing business. Their emotional range narrows over time. They don't get as high on wins or as low on losses. There's a steadiness. The behaviorally inconsistent person experiences everything as dramatic. Big wins feel validating, like proof that they're finally figuring it out. Losses feel devastating, like evidence that they're not cut out for this. They're always trying to get back to that feeling of being right. They're chasing the emotional high of a perfect trade. And that emotional need to be right, destroys edge. Because markets don't care about your need to be right. Markets just move, and if you need them to validate you, you'll make decisions based on that need rather than on probability. If you want to build this kind of behavioral consistency, it doesn't happen through analysis. It doesn't happen through studying more charts or learning more patterns. It happens through a daily practice that has nothing to do with markets. The practice is simple, boring even, but it works because it's addressing the actual problem. You start before the trading day, before you look at any market data, before you check what happened overnight, before you scan for setups, you sit down with your thoughts. You need a notebook. Physical is better than digital because the act of writing by hand engages your brain differently, but use whatever you'll actually use. You write, not about the market, about yourself. First, you name your current state. How do you feel today? Not in a vague way, specifically. Anxious? About what? About money? About performance? About being behind other traders? Confident? Why? Because you made money yesterday? Because you've been consistent lately? Tired from lack of sleep or from mental exhaustion? Bored with trading or with something else? Angry at the market or at yourself or at something unrelated? This seems simple, but most people skip it because they think they already know how they feel. They don't. Emotions operate mostly outside of conscious awareness. You feel them in your body, in your impulses, in your reactions, but you don't necessarily know what they are until you stop and name them. And unnamed emotions control you. Named emotions can be worked with. After you name your state, you write your rules. The same rules every day. You don't skip this even though you wrote them yesterday and the day before and the day before that. The repetition isn't about memory. You're not trying to remember the rules. You're trying to internalize them. You're trying to make them part of your identity. Every time you write them, you're saying, "This is who I am. This is what I do." The rules should be simple and specific, not vague aspirations like "be disciplined," but concrete commitments like "I will only take setups where all three conditions are met. I will risk exactly 1% per trade. I will set my stop loss before entry and never move it. I will close my platform after 3 losses in one session. I will not trade in the last hour before close. I will take profit at my predetermined target, not before, not after." Then, and this is the part most people skip, you write what would make you break those rules. You name the enemy. You write, "I will want to break my rules if I'm bored and no setups are appearing, if I feel like everyone else is making money and I'm sitting out, if I've lost money and feel desperate to recover it today, if I'm trying to impress someone, if I had a bad morning and want to escape into action, if I'm comparing my results to other traders, if I feel like I need to prove I'm competent." This isn't pessimism, this is preparation. You're not assuming you'll fail, you're acknowledging that there are predictable conditions that make failure more likely, and by naming them in advance, you're creating awareness. You're giving yourself a chance to recognize the situation when it happens. Then you trade, or you watch for setups, and before every trade, you pause. Not for long, 10 seconds, 15 at most. You're not trying to add more analysis, you're trying to check in with yourself. You ask, "Am I taking this trade because it meets my criteria or because I feel something?" And you have to be honest. If you're bored and the setup is marginal, don't take it. If you're trying to recover from a loss and you're forcing a trade, don't take it. If you feel desperate or excited or like you need to prove something, don't take it. Sometimes the setup is good and you still feel something. That's fine. You're not trying to eliminate emotion. You're just trying to see it clearly so it doesn't drive behavior without your knowledge. If the setup meets your criteria and you happen to be excited about it, take the trade. But take it because it meets your criteria, not because you're excited. After each trade, you write again. What did you feel during the trade? What did you do? Did you follow your process completely or did you deviate? If you followed it, what made that possible? If you deviated, what triggered it? You're not judging yourself. You're not trying to be perfect. You're trying to see patterns. You're trying to understand the conditions that lead to good behavior and the conditions that lead to poor behavior. Over weeks and months, you'll start to notice things. You'll see that you trade poorly after certain types of interactions. You'll see that certain times of day are more difficult. You'll see that certain emotional states are dangerous. You'll see that certain types of market conditions trigger your worst behaviors. And once you see these patterns, you can work with them. You can change your environment. If you overtrade when you're bored, don't sit at your screen all day. Have other work to do. Check for setups at specific times and then leave. If you trade poorly in the afternoon, stop trading at noon. If you're more aggressive on Fridays, reduce your position size on Fridays. If you make mistakes after arguments, don't trade on days when you've had arguments. These might seem like restrictions, but they're not. They're adaptations. You're designing a system that accounts for your actual psychology, not an idealized version of yourself. This is not exciting work. It's not the kind of thing that gets shared on social media. Nobody posts screenshots of their journal entries. Nobody brags about the trades they didn't take. But this is where edge is built, not in finding better patterns, in becoming someone who can execute simple patterns consistently. The people who skip this work always suffer the same fate. They might win for a while. They might have a good month, a good quarter. Beginner's luck is real because beginners often trade small and follow rules strictly because they're afraid. But eventually, they get comfortable, they gain confidence, they start to think they understand, and then the market presents them with a situation their psychology can't handle. Maybe it's a drawdown, a series of losses that comes right after a series of wins. They're not prepared for how that feels. They thought they were past this. They thought they'd figured it out. The losses trigger something: fear, desperation, the need to prove that they're not failing, and they start breaking rules. Or maybe it's the opposite. Maybe they have a huge win, a trade that makes more money than they expected. This is often more dangerous than a loss because it triggers overconfidence. They think, if I can make that much on one trade, imagine what I can do if I really push. They increase their position size. They take more marginal setups. They start to think the rules don't apply to them anymore because they're seeing something others aren't. And then they give it all back and more in a spectacular blow-up. Or maybe it's just boredom. Months of grinding, making small, consistent returns, and it feels like nothing is happening. They see other traders posting big wins. They start to wonder if their approach is too conservative. They start to wonder if they're missing out. And they change something, not because the market changed, because they changed, because they couldn't sustain the patience.
You can see this in the way they talk about their losses. They externalize them. The market was irrational. The news was unexpected. A whale moved price. Manipulation. Algorithms. Stop-loss hunting. There's always a technical explanation. And sometimes those explanations are even true. Markets are irrational. News is unexpected. Whales do move price. But these aren't exceptions. This is the condition. This is always the condition. And if you can't operate in that condition with behavioral consistency, you can't survive. The market is always uncertain. That's not a phase. That's not something that will resolve if you learn enough. Uncertainty is the permanent state. The people who succeed are the people who can act in uncertainty without falling apart, not because they're fearless, because they've practiced acting in uncertainty so many times that it doesn't require courage anymore. It's just what they do. The shift happens slowly. You won't notice it day to day. There's no moment where everything clicks and you suddenly feel different. But over months, something changes. It's subtle. You stop trying to predict what the market will do. You start predicting what you'll do. You stop looking for the perfect setup. You start executing your acceptable setup over and over. You stop feeling like you're fighting yourself. You stop having internal arguments about whether to follow your rules. You just follow them. Not because you're more disciplined than you used to be, not because you have more willpower, but because you're someone who follows them. It's identity. You're not trying to be consistent. You are consistent. The behavior isn't effortful anymore. It's automatic. It's who you are. This is the integration. You're not controlling your emotions. You're not suppressing them. You're not pretending you don't feel fear or excitement or frustration. You feel all of it. But those feelings don't control your behavior anymore. They're just weather. They pass through. And while they're passing through, you do what you do. You follow your process.
From the outside, you might look less impressive than the person with all the indicators and the complex analysis. Your charts are simpler. Your explanations are more basic. You don't talk about the sophisticated patterns you're seeing. You don't post hot takes about market structure. You just quietly execute, trade after trade after trade, following the same simple process. Your equity curve is smooth, not because you never lose, you lose regularly, but your losses are controlled, predictable. You don't have dramatic spikes or crashes, just a slow, steady climb with regular small dips. Your drawdowns are manageable. They don't trigger existential crises. They're just drawdowns, part of the process. You sleep well. You're not watching charts at 3 in the morning. You're not checking positions constantly. You're not consumed by trading. It's something you do, not everything you are. You have time for other things, other interests, other people. This might seem unrelated to performance, but it's not. The fact that trading doesn't consume your entire identity means you're not placing impossible emotional demands on it. You're not asking it to be validated. You're just asking it to be what it is, a process that produces outcomes based on probability. He's learned options now, and futures, and Forex. He's studying order flow. He's analyzing institutional positioning. He's following smart money. He knows so much more than he did a year ago, but he's not doing better. He's doing worse, actually, because his losses are bigger now. He's convinced himself that to make real money, he needs to trade bigger size. He's convinced himself that his problem is he's been too conservative. So he's levered up, and now when he makes mistakes, they cost more. He doesn't see what he's doing. He doesn't see that he's running from the real problem by diving deeper into technical knowledge. He doesn't see that every new system, every new indicator, every new approach is just another way to avoid looking at his own behavior. He thinks if he just finds the right system, he won't have to change himself. But there is no system that works without behavioral consistency. Every system requires you to execute it properly, and execution is about behavior, not knowledge. The tragedy is that Jordan will probably quit. Not all at once, gradually. He'll take a break after a big loss. He'll tell himself he needs to step back and study more. The break will get longer. He'll start to dread opening his platform. Trading will start to feel like a source of stress rather than opportunity. Eventually, he'll stop. He'll tell himself that trading isn't for him, that he gave it a shot but it didn't work out, that maybe he's just not cut out for this. And in a way, he's right. He's not cut out for it. Not because he lacks intelligence or talent, but because he wasn't willing to do the boring work of understanding and regulating his own behavior. He thinks if he just finds the right system, he won't have to change himself. But there is no system that works without behavioral consistency. Every system requires you to execute it properly, and execution is about behavior, not knowledge. The tragedy is that Jordan will probably quit. Not all at once, gradually. He'll take a break after a big loss. He'll tell himself he needs to step back and study more. The break will get longer. He'll start to dread opening his platform. Trading will start to feel like a source of stress rather than opportunity. Eventually, he'll stop. He'll tell himself that trading isn't for him, that he gave it a shot but it didn't work out, that maybe he's just not cut out for this. And in a way, he's right. He's not cut out for it. Not because he lacks intelligence or talent, but because he wasn't willing to do the boring work of understanding and regulating his own behavior. He thinks if he just finds the right system, he won't have to change himself. But there is no system that works without behavioral consistency. Every system requires you to execute it properly, and execution is about behavior, not knowledge. The invitation here isn't to abandon technical analysis. It's useful. You need some baseline level of skill to identify opportunities, but recognize what it's for. It's for finding setups, for structuring your approach, for giving you a framework. That's maybe 10% of what determines your results. The other 90% is whether you can execute the same simple process consistently, regardless of what you feel. If you wanted to start building this, you wouldn't start with more analysis. You wouldn't sign up for another course. You wouldn't buy another indicator. You'd start with one small change. Tomorrow morning, before you look at any charts, take out a notebook. Write one sentence about how you feel. Write one rule you'll follow today. Then see if you can honor it. That's all. Not forever, just tomorrow. You don't have to believe it will work. You don't have to feel motivated. You don't have to understand why it matters. You just have to do it. And then do it again the next day, and the day after that. At first, it will feel mechanical, like you're just going through motions. That's fine. You are going through motions. That's the point. You're building a pattern through repetition. After a week, you'll probably notice something. You'll notice that you're slightly more aware of your emotional state when you trade. You'll catch yourself about to break a rule and pause. You won't always stop yourself, but you'll notice. And noticing is the beginning of change. After a month, you'll have data. You'll have a record of your emotional patterns. You'll see the conditions that lead to your best and worst trading. You'll see that this isn't random, that there are predictable triggers. And once you see them, you can start to work with them. After 3 months, the behavior will start to feel less effortful. You'll still have to choose to follow your process, but the choice will be easier. The gap between knowing and doing will be smaller. You'll start to trust yourself in a way you didn't before. After 6 months, if you've been consistent with the practice, you'll be different. Not perfectly consistent, not immune to mistakes, but fundamentally different in how you relate to trading. It won't be about proving something anymore. It won't be about being right. It will just be about following a process, and you'll be someone who follows processes. This is how edge is built, not through finding secrets, not through learning what others don't know, but through becoming someone who can do ordinary things extraordinarily consistently. The market doesn't reward brilliance, it rewards reliability, and reliability comes from behavior, not knowledge. The people who make it long-term, the people who are still trading profitably 5 years, 10 years, 20 years from now, aren't the ones who knew the most. They're the ones who learned to know themselves, who learned to see their patterns, who learned to build systems around their actual psychology rather than an ideal version of themselves, who learned that the real edge isn't in the charts, it's in the mirror.